Hi, this is Tom Essaye from Money and Markets TV. Last week was a wild one in the markets, and we have European Central Bank President Mario Draghi to thank for the volatility. On Thursday, he said that the ECB will do whatever it takes to save the euro. Following that statement, Spanish government bond yields declined from record highs, and investors grew more confident about the outlook for Italy and Greece too. Here in the U.S., the S&P 500 bounced off of the 1330 support level it had been sitting on and continued to rise steeply for the next couple of trading sessions. However, I'm not convinced that this rally has legs. First of all, a lot of the gains were due to short covering from traders and portfolio managers who had made downside bets before Draghi's comments. But there were also some technical signs of weakness that should concern stock market bulls. For one, the rally was driven mostly by ETFs, not individual stocks. That's a sign that large investors don't trust the rally. They're trading it rather than reallocating capital and getting more long. Another troubling indicator was the fact that the Nasdaq and the Russell 2000 underperformed the broader market, as did sectors sensitive to the macro economy, such as materials, miners, and energy. Meanwhile, safety sectors like utilities and telecom led the advance. The opposite would be true during a real bull market. But the most interesting indicator I saw came from the bond market. 10-year Treasury prices completed what is known as a weekly outside reversal. On Wednesday, they made a new 52-week high, but then fell sharply on Friday to end the week lower. This type of shift is a powerful technical indicator and can signal a trend change in markets. In order to understand this reversal, you have to realize that U.S. Treasuries have acted as a safe haven for European investors over the past few months. The yields are certainly not attractive, but investors have been more worried about return of their capital rather than return on their capital. But now many of those European investors may be anticipating a game-changing policy response from the ECB. If so, much of the money that had flowed into U.S. Treasuries from Europe may now be flowing back out. There's no question the bond market is incredibly overvalued, and a decline will happen at some point. But like the housing bubble, there's no telling when it will happen. When it does, it will be a big trend change and could present you with a huge opportunity. One way to profit from a decline in bond prices is through the ProShares Ultra Short 20-plus year Treasury ETF, symbol TBT. It's designed to rise 2% for every 1% drop in long-term Treasury prices. Keep in mind, it's not yet clear if a trend change in bonds has occurred, but as contrarians, we have to be on the lookout for the signs of change so we can react before the crowd does. So you shouldn't ignore last week's signal and be sure to watch the bond market closely. I'm Tom Essaye from Money and Markets TV, and thanks for watching.